Now imagine this. Your system works, your entries make sense, but somehow, month after month, you still can't grow your account. Now what if the problem isn't your system, but what you don't know about your system? Now here's the question most traders never ask. What would your results look like if you traded your system to perfection, at the top of your own performance? Not emotionally, not impulsively, just clean, disciplined execution. No hesitation, no deviation. Would you be profitable? Would your drawdowns get smaller? Would your confidence grow? Now most traders never really find this out because they never really build the most important tool that can actually answer these questions, your very own trading journal. Now if you want me to convince you why you need to start putting in the work and doing your own journal, keep watching this video until the end. Now let's see what is the real purpose of a journal and why most traders get it wrong. Most traders think a journal is just there to record their trades, but that is the surface level. A proper journal doesn't record what happened, it reveals the truth about your system. So a journal tells you how your setups really perform. Not how you think they perform, not how they feel, but how they actually perform. A journal tells you which decisions drive consistency and which ones are costing you money. And a journal tells you how your strategy would perform if you executed it perfectly. Now your journal is the mirror that exposes everything. The mistakes you repeat, the setups that don't work, and the trades that you should have taken, but for some reason you didn't take. So, if you could clearly see which trades are holding your results back, would you still take those trades? So this is where journaling turns from a chore into how a professional develops their own edge. Now before we talk about the analysis of your results, let's talk about what actually goes into the journal. Because if you're only writing entry, exit, and the result, you're missing 90% of the insight. So your journal needs to capture data, visuals, and context. Here's what that means, and here are some of the key metrics to track. First of all, most importantly, the date and time of the trade. Was the trade during the London or the New York session? Because markets behave differently across different time zones. Second, the market that you're trading, the trading instrument, to get an idea of which pairs or assets your system truly performs best on. The type of setup that the trade was. So from your playbook of trades, which trading setup was this specific one? Over time, this helps you tell which setups have a real edge and which ones are just noise. The trigger that got you into the trade. So the exact event that got you in. Was it a breakout? Was it a retest? Was it an engulfing bar? Was it because you flipped a coin and you thought it looked good? I like to write down the time frame that gave me the trigger that I usually look for when looking to activate a trade. Next is the entry, the stop, and the target. Now always record these things in R multiples, not pips or dollars. Now the easiest way to do it, and the way I like to do it, is to mark up your chart with the levels and then take a screenshot of it. Another very important metric is maximum excursion. What is that? That is how far the price moved in your favor before reversing and coming back to hit the stop loss. Now we'll come back to why this number changes everything. Another thing you might want to track is correlated exposure. Were you in multiple correlated trades at the same time? So this shows you how hidden risk compounds. Now you'll see this from two entries that are triggered during the same time window on correlated assets. For example, trading the Euro USD and the Euro AUD at the same time. And another thing you might want to track is if you made the mistake in your execution according to your trading plan. So was the trade executed according to your plan? Yes or no? Now next is the visuals. Every trade should have a before and an after screenshot. So the before chart is what you saw at the time that you were entering the trade. The after chart shows how the trade played out. Now these two pictures side by side expose the truth. Did you follow your plan or did emotions take over? So why does this matter? Because each data point is later going to become a piece of evidence. And when you combine enough of them together, your system starts talking back at you. Because remember, the journal's purpose isn't just to record what you did, it's to understand the mechanics of your system, how it behaves, and how will you get the best out of this system. So before you start looking for the next fancy system out there, you gotta understand how your own system works. You'll start to see patterns that your emotions never noticed, and that's when your evolution as a trader begins. So this isn't about writing notes, it's about collecting evidence. Evidence that will later tell you exactly what is working and what is not working. Because in trading, all you have to do is do more of what is working and do less of what is not working. Haha, sounds profound, but that's as simple as it really is. So the real work in trading doesn't happen while you're trading. It happens when you go back to your journal and study the patterns after the trades are behind you and you are not so emotional anymore. So your journal lets you see in plain sight which setups are more consistent and which ones are silently hurting your results. So you start to notice patterns, time of day, session behavior, emotional decisions, and most importantly, you see what shouldn't be even in your playbook to begin with. So half the improvement in trading doesn't come from adding more things. It comes from removing things. Removing weak setups, removing the repetitive mistakes, removing all the noise that doesn't align with your edge. So, if you could remove the 3 most costly mistakes that you repeat over and over from your trading, how much better would your performance be? So your journal gives you the exact numbers to answer that question. So now, let's talk about the single metric that can transform your understanding of your system. Maximum excursion. Maximum excursion shows you how far each trade runs in your favor before reversing and coming back to your original stop loss. It's the metric that turns a static record into a dynamic testing tool. So measuring the maximum excursion would mean that for every trade you take, you mark on your chart how many risk to reward multiples that trade reached before coming back and hitting your original stop loss, regardless of where you took your profit, whether it was at a fixed risk to reward or otherwise. So regardless if your profit is at the 2-to-1 risk to reward ratio, measuring maximum excursion will help you see how many of all of your trades only traveled to the 2-to-1 and then came back and hit the stop loss, or how many of those trades traveled to 5-to-1, 10-to-1 before they came back and hit the original stop loss. So with that number alone, you can take the same set of trades, the same data, and simulate what would have happened if you had traded different risk to reward targets. So what would have happened on this same series of trades if I closed every trade at the 1-to-1? What if I closed all trades at the 2-to-1? And what if I held all trades for the 5-to-1? What would be the difference in the results in each one of these strategies? So with the same signals and the same data, what would be the difference in profitability for each of those scenarios? So now you can start to see, with evidence, which target would have produced the best results for your strategy over a large series of trades. Now it's great to sit back and remember that trade that you closed at the 2-to-1, but you remember that it ran all the way to 10-to-1. But in order to put such things into context, we have to measure them. Only through measuring the results can we identify how to improve them. What gets measured gets improved. So suddenly, you're not guessing, you are testing. And what the data shows you will often shock you. Every trader dreams of those massive runs of 5R and 10R. But when you apply those targets to all the trades in your system, the win rate usually drops so much that your total return is lower. So the data may show you that the 1.5-to-1 risk to reward or the 2-to-1 actually gives you higher net returns, smaller drawdown periods, and fewer emotional swings, which all of that leads to a smoother equity curve. That's because your journal is showing you the reality of the market rhythm, not the fantasy, not the dream. And here's where most traders get humbled, because your journal often proves that your best trades may not be the big ones, but maybe they are the most consistent setups. So when you analyze enough trades, you'll start to see that each month has its own slightly different story. On some months, maybe the 3-to-1 target outperforms. On other months, maybe the 1-to-1 or the 1.5-to-1 performs better. But when you average multiple months together, a pattern emerges. The risk to reward ratio that produces the most stability most often. That's your system's natural operating zone, where it breathes best through various different market cycles. So trading inside that zone gives you a smoother growth, lower emotional swings, and more consistent returns. So have you ever wondered where is the real sweet spot of your system? The point where performance and psychology both align. So your journal can show you that, but only if you put in the work to create the journal in the first place. And once you discover it, trading becomes calmer. You stop second guessing whether you should hold or exit early because the data tells you what works and what doesn't. And that kind of consistency doesn't just stabilize your equity curve, it also stabilizes your emotions. Because when you know what to expect, you stop fighting yourself. So of course, traders love the home runs. But once you've been in this game long enough, you realize the priority isn't to make the biggest wins, it's to avoid the biggest drawdowns. This is one of the most important things that professional traders understand. Big winners also have their role to play, but avoiding big drawdowns is far more important. Big drawdowns create doubt and emotions. Doubt creates mistakes, and mistakes destroy both consistency and profitability. That's why, especially for short-term traders, smoother, smaller wins often outperform the hero trades. And your journal will prove it. Not theory, not emotion, but data. Hard data. And once you see it clearly, you'll trade with more patience, less pressure, and better results. So you stop chasing the dream trade and you start optimizing for stability instead. And once you see how much calmer your trading becomes, you'll never go back to the old way. Now, that doesn't mean that big winners are not part of the game. They are still a major key to peak performance. But there is a time and a place for those types of trades. So there are moments to go for the home run, but that is not the normal. And you should not base the majority of your trades on something that doesn't happen frequently. Now we will talk more about when is the right time to go for big winners, but that is part of another video. The more things that you measure in your system's performance, the more things that you can quantify. Now the same data that helps you analyze your risk to reward targets can also reveal something most traders never actually test, their trade management strategy. And this one insight actually changed my own trading completely. So if your journal has enough data, you can actually simulate what would happen if I trailed all my stop losses to break even after the first target is met. What if I take partial profits at the 1.5R? Or what if I never move my stop loss at all from its original position? Now, by applying those variations to the exact same trade data, you'll see which approach creates smoother, more consistent results. And here's where I'm going to share a personal lesson because my own journal changed the way that I manage my trade. So for a long time, I used to trail my stop loss to break even as soon as the first target was hit. It felt logical, it felt safe in order to protect capital and reduce the risk of the trade. But over time, my journal told a different story. I kept seeing the same kind of pattern. I'd trail my stop loss, get taken out at break even, and then watch the market go and hit my full target a little bit later on. Now, it was a bit brutal, but it was the truth, and the journal proved it. So what I discovered was that trailing the stop loss too early might work on the longer term time frames where you use wider stop losses, but on the shorter time frames, it often killed performance. Actually, what it did show is that when I was going for the 2-to-1 target, but trailing my stop loss to break even after the 1-to-1 was met, it produced very similar results as if I had taken all my trades at the 1-to-1 target. So whether I was trading with a 2-to-1 target but moving my stop loss at the 1-to-1, or whether I was trading with a 1-to-1 target produced the same exact results. So the 2-to-1 performance became the same thing as a 1-to-1 performance because trailing the stop loss. Because half the time, the market would reach the 1-to-1 and then continue going to the 2-to-1. but the other half of the times it would reach the 1-to-1 and then go back to my entry level and take me out. So the solution I found, again, through the data and the journal, was instead of moving my stop loss, I started taking partial profits at the first target and letting the rest of the trade play out without moving my stop loss at all. Now the difference in results and in mindset was clear as night and day. Now of course, doing this on your own system will very much depend on your system's risk to reward and the time frame and the size of the stop loss, but we'll explore that deeper again in another video. But the lesson still stands. What feels safe emotionally isn't always what performs the best mathematically. And without journaling, I would have never seen that pattern so clearly. That's what the journal reveals. Data over instinct. That's the power of the data. It strips away emotion and it replaces it with evidence. And once you have evidence, your trading decisions stop being about guesses and they become strategies. Now, every trader has two performances. Their theoretical performance, how their trading system would perform if it was executed perfectly. And number two, their actual performance, what you actually produce on your live trading account. Now, the difference between those two performances is what is known as the execution gap, the difference between theory and practice. And that gap is where most traders lose their edge. Now, the journal helps you pinpoint and measure exactly the magnitude of that gap. So instead of changing strategies, what you need to do is perfect the execution of your own strategy. So by journaling every valid setup, not only the trades that you took, but all the trades that match your system that you maybe didn't take. So in order to do this properly, you have to measure all the trades that agree with your trading strategy, whether you took them or whether you didn't take them. And once you measure all of them together, you can start to see both realities side by side. So if your theoretical system produced 8R last month, but your live results were only 2R, your problem isn't the system, it's execution. So your job becomes very simple. Close the gap between theory and practice. How? By reducing mistakes. So every mistake you eliminate moves your results closer to your system's true potential. Because consistency doesn't come from doing more. It comes from doing fewer things wrong. One less mistake at a time. That's the real journey, not perfection, just precision. So why does journaling matter so much? Well, here's the truth. Journaling isn't fun, okay? It's not fast, it's not flashy. Actually, it's slow, it's detailed, it takes discipline. It takes doing it every day or every week. But this is where professionals are built. This is how you turn chaos into structure, guessing into confidence, and emotion into evidence. Because once you see your data, once you can prove why you do what you do, no market condition can shake you out. You stop chasing the next best thing, the next random system, and you start perfecting your own edge. And that's when trading finally starts being more calm. Because you're not hoping anymore, you're proving your edge statistically. So let's recap what we've covered today. Journaling isn't just record keeping, it's refining your trading system and finding your true edge. You have to track every detail, setups, triggers, session, and most importantly, maximum excursion. You have to use the data to test multiple targets, multiple management styles, and find your performance gaps. And ultimately, what you're looking to find is your system's natural rhythm, the sweet spot between profitability and consistency. And above all, you use your journal in order to make fewer mistakes, not just more trades. So your journal isn't just a record, it's your data-driven blueprint for consistency. When you track max excursion, you test targets, you analyze your trade management, and you measure your theoretical versus your actual performance, you are creating evidence, not opinion, of what actually works. So your job as a trader is to close the gap between potential and execution. Fewer mistakes, cleaner data, more confidence. That's how you unlock your true edge inside your system, and that is how you unlock your full potential as a trader. So here's your challenge. Start journaling like a professional. Do it for 1 week first and then extend that and do it for the whole month. Track every valid setup, not just the ones that you took. Record the max excursion, test the R&R targets, evaluate your trade management rules. Because once you have the data, you'll stop guessing and you'll start trading with proof. So let me know in the comments, did I convince you to start journaling? So for the ones that actually do journal, let me know in the comments, what's the biggest thing that your journal revealed that surprised you the most? And I will catch you in the next video.